Good morning, good afternoon, good evening. Welcome to the AI 2030 show. My name is Xiaochen Zhang, the CEO of FinTech for Good, and also the Executive Director of AI 2030, your show, the host of AI 2030. Today, we have a special guest and also a good friend, Sandeep. And before we start, just dive deep into the topic, and I'd like to just have you to introduce yourself to our audience.
Okay, thank you, Xiaochen. Firstly, thank you so much for inviting me for this discussion. Really found Xiaochen to be a great thought leader in the field, frankly. He did a great conference for AI 2030 recently. In terms of myself, my background's been almost entirely in analytics and algorithms. I started out by bachelor's and master's from Cornell in algorithms, and I actually took an AI class at Cornell 30 years ago. And as a side note, in that class, they were talking about different techniques, and neural networks was only one small part because it was still not very powerful yet. But the textbook said, which I was actually reading again after 30 years, a few days ago, it said that, there's a small group of people called the neural network researchers who believe that with enough computational capacity and enough data, neural networks can emulate human thinking and decision making. And the book went on to say that only time will tell whether they're right or not, which I thought was pretty amazing that 30 years ago that even people then were thinking, that this would be very powerful and would change essentially a lot of things, frankly, in this space. So in terms of my background, I didn't follow AI at that time because there wasn't too much activity in the AI space. As I think many people know, it was the AI winter. I applied essentially my skills and interests in analytics to financial services. I worked at a bunch of different financial companies, designing and developing and implementing, large scale systems for leveraging a lot of analytics, in particular in the risk field and trading fields. So I basically ended up heading risk technology for different groups in JP Morgan, both on the buy side and the sell side. I headed all of risk technology for JP Morgan Asset Management, and then later was head of risk and compliance technology for all of BNY Mellon. And then very recently, I founded a company to leverage AI and machine learning techniques for financial risk management. And that company is called Raven Risk Intelligence, and I'm the co-founder and CTO of that company.
Thank you. Definitely, you are a veteran in the financial service industry, and when you just look back your whole career, and emerging technology definitely have played a very important role in the whole last past 30 years, and then to transforming the financial service industry. And can you just give us some examples in the past how some exciting technology just really fundamentally changed some of the things that how financial service or financial institution providing services to their customers?
Yeah, sure. So I think financial services tends to be huge consumers of data, and also to a large extent, the computational needs are pretty big. And I think they're one of the biggest, if not the biggest, vertical industry. Besides, of course, the tech companies themselves, that leverages basically large scale data sets, and also needs a lot of computational capacity. So frankly, I think from my own personal experience, we were able to create a lot of business value by having the ability to process very large amounts of data and then come up with insights even before machine learning was present, to come up with insights that the business could use essentially for to grow their business. Just a couple of examples from my corporate banking experiences that we basically were able to optimize essentially what the risk is from our clients, so that essentially we knew we had a pretty good idea of how much essentially risk we could take on with different clients of the many banks that I worked with. And, in the banking business, like risk is fundamental. I think arguably it's almost the biggest decision-making factor is, how much of risk can you take on when you're basically serving a client. So I think the data and the compute is extremely important. Having enough data and good quality data is also, the ability to run basically sophisticated analytics on that data is very important to determining how much of risk you think the client may have, and therefore how much of money you can lend to them, or how much trading you can, even trading activity even is determined by how risky you think, essentially how much risk you can take on with a client. So I think it's been completely transformational. Frankly, from what I've seen the last 30 years, it's been transformational. Now I'm happy to talk about the AI part of it if you want, Xiaochen, but I'll let you lead the discussion.
Yeah, definitely. You talk a lot about, if I understand it correctly, that's at least three main components. One component you're talking about the digital infrastructure, because financial services are dealing with a lot of data, so then you need a computing power, and naturally that is the cloud computing, and those kind of technology, and be used to transform that what kind of infrastructure can support what kind of operation and also customer services. The second piece is that leveraging data to make a smart decision making for the financial. Those decisions will have two dimensions. One dimension is really customer related service, right? It's a product and lending and all those products. The other is the risk management piece. That's you mentioned, where that's while you offer service, how to mitigate it. So all of them require different type of new technology to just address. And as you mentioned, that definitely we want to dive deep into the AI piece, and maybe for folks who don't understand or are not part of the financial service industry, and can you just give us a short one-on-one for the risk management? Why risk management is important for financial service industry, and normally without AI, how a typical risk manager is doing his job on a daily basis?
Yeah, no, that's a really good question. So I think, firstly, in terms of how, where before, at least AI, the way things were working was that, people were getting, and there's been improvements in terms of, I would say, the types of data they're getting. There's more quality data that people are getting and risk managers are getting. Now one of the things is that there's some automation, but after they get the data, not all of it is completely automated. So essentially on the what's called structured data side, which is, let's say, numerical data in a tabular format, that basically there's a lot of automation and ability to ingest that data, put it into a database, and and export that for informational purposes, maybe use some of that data to models also. The part that is new, that has not been achievable till machine learning and large language models have made progress in the last couple of years, is the unstructured data, which is essentially data that is not formatted and not structured in like a tabular format. That includes text data, images, voice, audio, things of that sort. It's not been really possible to process and ingest those at scale. So I think with the advent, particularly of large language models, you can take unstructured data, have essentially machine learning algorithms, and not people, ingest that information and essentially curate it and come up with some summaries and even insights. So it's become really powerful in a very short period of time. Not only can you ingest that data automatically, which you couldn't do till frankly about a year or two ago at scale. And then secondly, basically the large language models and other models can even then use the data that they've ingested to come up with some insights, like some perspective on what things might look like and some information. So that's basically, I think, going to be a complete game changer, frankly, from a financial risk perspective. So the two things, broadly speaking, one of them is improved productivity by reducing the manual effort needed to source this unstructured data and try to summarize it. There's a lot of work done by banks and risk to do that. Information, for example, for lending decisions or borrowers ratings and things like that. Sorry. And the second reason is then coming up with better insights using this unstructured data in terms of recommendations to risk managers about the credit worthiness, for example, of a borrower. So that's the second predictive, I would say, insights and analytics is the second benefit of this.
Yeah, and thank you. You break down really, the whole value chain of risk management, especially the data component. For a risk manager from just collecting data, then bring and clean up the data. And then you also need to just make a decision. Then you visualize, and then visualization piece, which just really provide that final decision making guidance. Where that's a lot of time that people or talk about the last part, right? Is the machine learning and visualization and all that. But a lot from a lot of conversation I had with especially AI experts, that many of the challenge are not the later part. It's not at the machine learning model. It's not as visualization, because there are ton of investment and tools go into it. But there are limited offers, especially those large scale high potential offers are not available. And to address the beginning of the process, which is you have structured unstructured data, and then how to just improve the data quality and then all that. Tell me how important it is to solve that problem, and also do you have some numbers in terms of the sizing of the problem, and also if that problem is not solved, what will be the impact to the later part of the process?
Yeah, no, I think that's a really good question. So like, listen, data is fundamental, and also if the data is not of good quality, right? Firstly, it is garbage in, garbage out. So if you get the data is not of good quality, and then it's not cleansed or validated, then essentially the models only work on data. I mean, they don't know anything else. So like, if you give them basically, so I think it's very important basically to ensure that the data quality is good. And there are actually some machine learning techniques that have been around for a while, actually, that can identify anomalies in the data sets. And so basically, in fact, machine learning can help even in the beginning part of the process in terms of data validation and and curation. So so I think you're correct about that part. And then I think, as you were saying, basically, then that basically becomes foundational to later on to essentially do machine learning to find patterns in the data. It also enables the users, including risk managers, maybe even external users, to be able to query the data and so forth. Now, one thing the banks that is, and I speak to a lot of banks actually as well, is that almost all the big banks, probably all of them, are starting out by using knowledge retrieval, because for their internal users, including risk managers, including customer service agents, including regular employees. And that's because it gives the improved productivity to their internal employees by enabling them to find the information that they need to do their regular jobs and find that information more quickly. But it's also relatively low risk, because you're not facing external customers directly. I think I don't know of almost any case where basically machine learning and particularly LLMs are facing external customers directly today. I think there's a lot of concern that, and right for good reason, that the LLMs are not yet fully, I would say, accurate and also explainable, so that essentially that regulated industries like finance and maybe also things like healthcare have comfort for those models to directly face customers without a human being in between. So I think that's the stage we are at, frankly, today.
Yeah, and now let's dive deep into your solution or your company. That's so within this, are you addressing the problem of the whole value chain, or are you addressing one part of the value chain? And as an AI company, that what is the specific AI related component which is supporting that piece or that problem that you try to solve?
Yeah, that's a great question. So firstly, I think our objective is to streamline and optimize and with both productivity gains as well as better predictive insights and recommendations for the credit process. We're starting out with credit lending and credit risk. So essentially, in terms of that, actually turns out that this is like almost a perfect example, a use case for machine learning, because in the first part, there's a lot of unstructured data that credit analysts use and try to acquire. That is very tedious. It takes them a lot of time. In fact, it takes them so long sometimes that some banks are even losing out on deals because it's taking a long time for their credit team to acquire the data and to analyze the data. In the meantime, some other bank will move more quickly. So the first part basically is to optimize using machine learning, the acquisition and curation and summarization of this data, a lot of which, like I said, is unstructured. Like it includes things like annual reports, earnings calls, even news. Coming up with techniques to summarize that, and then using LLMs. I would say LLMs with some parameters to basically come up with more accurate predictions. Now, one thing is, as I was just pointing out, is that that process is not completely accurate. So I think there's a couple of things we're doing to mitigate that. So one advantage we have is that we have a very strong team of people inside our firm that are experts in credit, in credit. So one of our the head of essentially our credit function in our venture was head of all of credit risk, and actually he was the chief risk officer for RBC in the US. And my other co-founder was CEO of RBC's US holding company, and he was very involved in building out the RBC US corporate bank. So I think those people are domain experts and they're very hands-on. They basically are themselves actually providing inputs to train these models so that we know that the outputs are going to be accurate and not generated solely by machine. Then the next step in the process is that the machine basically tries to come up with correlations between the different inputs and then what the outputs look like. So for an example would be that if there is basically like let's say like let's say there's a kind of an event like a flood, say in Florida, right? What is the impact to this particular company if there's a flood event or hurricane event? We can, through machine learning, assess the impact of those kinds of variables to the potential impact to the company, any given company actually, in almost real time, because our models are trained to determine basically for different types of sectors and even companies what are basically the factors that affect the business of that company. So I think that's another area where you were using, starting to use very advanced, frankly, machine learning techniques to come up with some outlooks that then the credit then essentially the credit lending, people can, and these companies can use that as an input. It's not that we're saying you have to follow this, but if there's a hurricane, for example, in Florida, like, be aware that and keep a lookout for essentially the stability of this company or the revenue of this company, over the next, let's say 1 year, something like that.
Yeah, and in the model that's to make that final suggestion or prediction, that how many parameters are you put into that? Is like in the tens or in the hundreds or in the so what is the, you don't need to give the specific number, but it just a general idea.
Yeah, I mean, I think basically, like it turns out that with not even okay, in terms of, I would call it input variables from from a business variable standpoint, like I was talking to you about, like let's say weather events and things of that sort. Like essentially, the good thing actually is that the model itself, basically, we have a phase that's unsupervised learning where it basically learns how many factors and features are relevant. Then basically we have a human overlay that takes a look at those factors and features, and we have the ability to tweak them as our experts, our domain experts, in the company feel fit. I mean, I think just now basically they're probably, like, in terms of distinct features and factors, there's probably a few hundred, because it turns out you don't need much more. Otherwise, it becomes overfitted. There's, as you may have heard of overfitting, but it becomes too specific and the model becomes too sensitive to individual things if they're too granular. So you actually don't want a model, at least in this stage of the game, where I think the models are still relatively new, to have too many individual features, because that can produce overfitting. Now, the models themselves create internally, the neural network models, millions and billions of parameters. So there we use the internal models. Once you create the features, then they translate that into neural networks. They have frankly, billions of parameters, which is, I think, getting to be pretty standard these days.
Thank you. Yeah, I think that is very helpful. And when you talk about, credit risk, and definitely, that also just impact significantly to the, lending practice, right? And when we talk about lending, we talk, one concept we discuss a lot in the, conference was fair lending, right? And so in the fair lending practice, and now fair lending supported by AI, and then a lot of questions go to say how how to just make sure that the model itself is explainable, and also the fair lending practice are being integrated in the model itself to address potential unfair treatment or bias and all that. So have you and your team started to just also put thought into that, and then that the credit risk related prediction and results can help financial institution to understand better of the result, and also explain that to both the final customers and also to the regulators?
Yeah, that's a great question. So, I think there's broadly speaking two segments in credit in the financial space. One of them is consumer credit, and the other one is commercial credit. On the consumer credit side, I would say in terms of progress, many of the larger banks and also even credit card lenders are you already using machine learning techniques, but using structured data. So, for example, they may take existing credit bureau data, and before they were using more basic closed form models. Now they're starting to use machine learning models, and they are using some of those models in production already. And the regulators do ask a lot of questions, but it's making progress. I don't believe there's any major bank that is using unstructured data, the kind that we were talking about earlier, with machine learning and neural networks to come up with credit recommendations today. So that's an area that I think is of active, that will probably happen, but in the consumer space, I think it'll take some time. In the commercial space, it's slightly different because the borrowers are institutional borrowers, so their bias considerations are there, but they're not like race or zip code and things like that. So it does make frankly the problem a little bit easier in the commercial lending space. There's bias concerns, but they're not as severe as in the consumer space. And then the other thing, which is kind of interesting, is that the private credit lending, which is essentially lending by non-bank institutions, has exploded. It's approaching $1.5 trillion and is expanding very rapidly. And those institutions they don't take depositors' money. So while they definitely need to be very careful about their lending recommendations, but they're not putting regular depositors at risk. It's not like regular people are losing money because of a bad lending decision. It's not. Their investors are large players, like pension funds, institutional investors, rich family offices, things of that sort. So it's a little bit different of of a space in the commercial versus consumer space. Now, in terms of explainability, which you're asking about, the models that use structured data, essentially, turns out they're slightly simpler than machine learning models. And so there are techniques like Shapley values and SHAP, that can help explain those types of models. Deep neural networks and large language models which are used for unstructured data, especially, those are harder to explain, and I believe that there's still room for research and progress in that area. And frankly, that's where our company is coming from, right? So we're basically working very closely with some, frankly, pretty expert researchers in the ML field and even the ML and finance field, who basically are researching essentially ways to, make those models more explainable so that our customers as well as the regulators, are obviously are comfortable with it as well.
Yeah, and thank you for that. And we all know that financial institutions are very conservative, and they have a good reason to be so. And to adopt any new technology, there's whole process, and also it takes time. And for you, that's now that you were on the other side of the table, and just making decision on behalf of the largest financial institutions to select vendors, to select which direction in terms of technology adoption that the institution will go for. Now that you sit on this side of the table and working on something very exciting, and then in terms of the adoption, and you take both hats. So what would be the driving force for financial institution to say, okay, and I want to just use your solution today, now, and I'm ready to. And then what are the factor or barriers from that decision maker to just make that decision?
Yeah, so I think, listen, I think basically that there is a lot of progress, interest, and even some adoption in the low risk, high value part of some of this process, right? So I think, for example, like the part that I was mentioning earlier about taking different types of data, finding out having the ability essentially to query that data, come up with some, let's call it summaries and some idea of, let's say, outlooks, without actually coming up with a very definitive recommendation, which is risky. I totally agree. But I think everybody's okay, even the regulators are okay with people using it for let's say internal productivity purposes. So that basically I think is something that if having come from the other side, as you said, rightly said, I think we are I think the organizations, even banks, are okay with that and are starting to use that. I think the part that basically is starting to make more progress, and there's a fair amount of interest in, is basically I guess two kinds of risk, frankly. One of them is the people that are basically coming up, these AI companies that are coming up with these solutions, do they really understand how financial companies work? What are the considerations in terms of risk with vendors, risk with models? To be frank with you, I think a lot of fintech companies are very good in terms of technology and very strong in terms of technical skills, but they don't have a background in finance. So part of the reason I think, frankly, our company is starting to gain quite a lot of traction is because we speak the same language and we understand the concerns very well of basically these financial institutions, because actually all three of my co-founders were in the senior people in the banking side before. So I think that's why I completely agree with you. You need to understand their concerns and the regulatory concerns also to make progress in finance, which is highly regulated and frankly quite conservative.
Yeah, and so now that we dived deep into what you're doing, and also what why it is exciting, and beyond what you're doing, just look at the space, and this show is called AI 2030, and which means that we really want to just look ahead and see that in the financial service industry, and by 2030, and how does the risk management will be done, and also how financial service will be provided, and what will be the customer experience could look like, and then how AI will potentially play a role there. And so it's just some future predictions.
Yeah, no, I think that's a good question. So firstly, I think, on the positive side, and I think people often focus these days, I find, frankly, on particularly in terms of the corporate side, individual people are very worried about, things like it's making bad decisions or it's going to take away their jobs and so forth. So my view is frankly more positive, which is that actually, I think, if done right, and if done right is the important part, it can actually help come up with better decisions and maybe even help individual people and individual businesses more. So an example is that, when you're basically making credit decisions today, you're basically taking into account the traditional credit history of the borrower. Like, did somebody pay their credit card on time? Did they pay their loan back on time, etc. But it does not take into account, other factors that are actually in very important too. Like, for example, you can see whether somebody paid their utility bills on time, and maybe they had a short period of time where they didn't have a job, or they couldn't pay, let's say their loan payments, right? But it doesn't mean that they're a bad credit, overall, right? So I think basically you can figure out through patterns essentially of consumer and even commercial behavior, what actually makes sense. And by doing that, you can expand actually and give credit to people and institutions even that have had less access to credit before. So I think there's definitely, and we're seeing that, by the way, in the data, we're seeing basically that people who traditionally were not being given credit easily, actually ended up being really good credits in the long term, right? And so I think, this is an opportunity actually to help people who are and companies who are underserved, frankly, including minority companies, that are not getting as easy access to credit. So that's one of, frankly, our long-term objectives also. So I think by 2030, you will see basically, I'm hoping anyway, that you will see basically more access to credit to underserved borrowers. The other thing that I think is, from just a pure risk management perspective, I guess, and commercial risk management perspective in particular, is that, there are lots of different types of risk, and that no bank today, frankly, has a very good way of understanding the interplay between different types of risk. So, like, for example, like, how does one type of risk affect another? And maybe cause, a correlation between different types of risk. So there's market risk, there's credit risk, there's liquidity risk. And it's hard enough for institutions to manage each of these individual vertical kinds of risks, but it's even harder for them to figure out how they interact with each other. So I think by 2030, or maybe slightly afterwards, my view is that there will be a much better and more robust integrated risk framework that's holistic, that basically can model through, lots of data, but also very advanced machine learning models that can handle so many parameters across different types of risk, can come up with, I would say, better insights into the different, how these risks might play out in the future. So that's my hope, which is it's called, the holy grail of risk management. For many years, people talk about integrated risk management, and it hasn't been there yet. But I think now with machine learning, I think there's a decent chance that next 5 to 7 years, that we will start to see true integrated, risk management framework.
Yeah, that could be, either the future of your current, company, or can be your, next company, and which can just help to realize, this vision. So thank you very much. And again, that this is such a wonderful conversation. Each time when I talk to you, I learn a lot of new things. And so for others who want to just follow you or just reach out to you, what would be the best way to find you?
Well, I'm available on LinkedIn, and I think you have my name, and I do actually check my LinkedIn pretty regularly. I'm happy to actually, and on my LinkedIn, I actually have my address as well. And so, yeah, I think LinkedIn, frankly, is my, probably just, I'm the only Sandeep Maira on LinkedIn in the whole world.
Perfect. So thank you again. And so for anyone who want to just, contact Sandeep, reach out on LinkedIn, and definitely will invite Sandy back in the future for our future show. And he is definitely, part of our family, and here in AI 2030. And again, thank you for your time, and welcome to the next show tomorrow. And we're going to have the professor from University of Illinois, and then we're going to talk about algebra fairness. And stay with us, and have a great weekend.
Thank you, Xiaochen. Have a great weekend too. Thanks to all your listeners for listening as well. Thank you very much.
Thank you.